What if there was a dividend ETF that paid investors over a 10% dividend yield and also had the potential for long-term capital appreciation in the long term? Well, this is something that investors can expect when it comes to investing into a covered call ETF, something like JEPI. Now, covered call ETFs are a type of exchange-traded fund, or ETF, that invests in a portfolio of stocks and uses a covered call strategy to generate income. In a covered call strategy, the ETF holds a portfolio of stocks and sells call options on those stocks. The call option gives the buyer the right to buy the underlying stock at a predetermined price, known as a strike price, within a specific time period, known as the expiration date. When the ETF sells a call option, it collects a premium from the buyer side. This premium is income for the ETF and can be used to offset some of the ETF's expenses, or in most cases, paid out to shareholders as a dividend. If the stock price remains below the strike price, the ETF keeps the premium and the stock. If the stock price rises above the strike price within the given time frame, the buyer of the call option may exercise the option, and the ETF will be required to sell the stock at the strike price. If this happens, the ETF would realize a capital gain or loss, depending on the difference between the strike price and the stock's current market price. Now, the main benefit of covered call ETFs is that they can provide investors with a steady stream of income, as the premiums from selling covered call options can generate regular amounts of cash flow. This can be particularly appealing in low interest rate environments where other income generating instruments, such as bonds, might be on the lower end of yields. Also, covered call ETFs can generate income in an environment where the rest of the market might be selling off or trading sideways. But with covered call ETFs, there's also some risks associated with them. For example, if the stock market experiences a significant downturn, the ETF's holdings could decline also in value, potentially offsetting any income generated from the call options. So in theory, if a covered call ETF is generating 10 or 12% from dividends per year, but the ETF's share value has dropped 10, 20, 30% within this given time frame, the investor would still be at a net loss. Now, in this video, we are going to go over and talk about one of the most popular covered call ETFs known as JEPI, and if or if not, it could be a potential good investment. Now, JEPI is an acronym for the JP Morgan Premium Income ETF. This is an exchange-traded fund, or ETF, that seeks to provide investors with income and capital appreciation by investing in a diversified U.S. portfolio. Now, in JEPI's portfolio of U.S. equities, they also sell covered call options on these equities to generate more income. Now, JEPI's portfolio is composed of U.S. large-cap stocks, which are selected based on a proprietary model that considers factors such as valuation, momentum, and quality. The ETF uses a rules-based approach to select and weight its holdings, and it rebalances the portfolio on a quarterly basis. Now, simply put, the JEPI ETF is designed to provide investors with a substantial amount of income every single month, and of course, on top of that, the potential of capital appreciation by investing in a diversified portfolio. And of course, using the covered call strategy to not only generate income, but also potentially help with downside risk. Now, looking a little bit further into the JP Morgan Equity Premium Income ETF, the fund was established in 2019, so it has not been around all that long. The fund's ETF price is up 6.73% as far as all time. So more or less over the last 4 or so years, the fund has not appreciated all that much, but remember, this covered call fund does pay a hefty amount in dividends. The 52-week range for JEPI is 49.92 as the low and 58.50 as of the high. So although we have seen the market do some crazy things over the last 52 weeks, JEPI has for the most part stayed pretty steady. Now, JEPI's expense ratio is 0.35, which is more or less the industry standard for covered call ETFs. The dividend frequency is monthly, which income investors love. And the assets under management is $25.57 billion. So definitely on the larger end of assets under management for an ETF like this. Now, speaking of JEPI's dividend, the dividend yield for the trailing 12 months is 11.32%, which is much higher than most other ETFs or stocks in the stock market. The annual trailing 12-month payout is $6.19, which is substantial for an ETF that costs around $50. Now, JEPI's dividend is paid out on a monthly frequency, but as you can see from JEPI's dividend history, the amount paid out is not the same every single month. There's been some months where JEPI's paid out over 60 cents per share per month. And just recently, back in February, JEPI paid out just 41 cents per month. So the amount that JEPI pays out on a monthly basis is going to depend on things like market volatility and how the underlying holdings are performing. Now, looking into JEPI's holdings breakdown, the fund is pretty well diversified, with the top 10 holdings being very familiar. The top 10 holdings being the Hershey Co., Pepsi, Microsoft, MasterCard, Progressive, Coca-Cola, Amazon, abbvie, Comcast, and Visa. But remember, JEPI also deploys a covered call strategy on these equities. Finally, maybe most importantly, let's take a look at JP Morgan's total return since the inception of the fund to see if or if not the JP Morgan Equity Premium Income ETF is or has been an actual good investment option. So if on the time frame we use the last 3 years with JEPI versus the S&P 500, just going off of price return alone as the metric, the JEPI ETF has returned 9.42% as far as price return goes versus the S&P's 43.69%. Now, this is just price return. So if we go in here and change it to total return, this is with dividends included, JEPI has returned 43.98% over the last 3 years when the S&P has returned 50.72% over the last 3 years. So just in theory, if you were to have invested in JEPI and the S&P 500 at the exact same time 3 years ago, you would have been more or less better off just buying into the S&P 500 and not receiving that big juicy dividend. But for more income-oriented investors that do rely on a dividend to pay for their bills and their life, a covered call ETF like JEPI has actually done quite well over the last 3 years. And what's interesting is that if you look at the total return for JEPI versus the S&P 500 on the 1 year time frame, for example, in total return, which means dividends and share price included, JEPI has returned 8.57% and the S&P has returned 6.76%. So on various time frames, JEPI actually does even beat the S&P 500. And it's hard to know in the long term what JEPI will do because the fund has only been around for just a little bit over 3 years. So as time goes on, we are going to see exactly how JEPI does perform and of course how the dividends look over the long term. But for right now, we only have so much data and so much time to really go off of. So the question remains, is the JP Morgan Equity Premium Income ETF a good buying option for a dividend or income focused investor out there? I do happen to think that for an income oriented investor, the JP Morgan Equity Premium Income ETF could have a place in your portfolio. Now for me personally, I do own around $60,000 plus of JEPI throughout my portfolios, but keep in mind this makes up less than 5% of my overall holdings. So would I personally, as a younger investor, allow JEPI to be a larger portion of my portfolio? At this time, I wouldn't. But as time goes on and as we can see more and more data and more performance history for JEPI, maybe in the future it would be. But I want you to comment down below. Do you think JEPI is a good buying opportunity for an income-oriented investor? Or if you think there's a better covered call ETF out there, comment it down below. If you enjoyed this video, make sure to please drop a like on the video and subscribe for more content like this.